The MACD indicator. In this video, you'll learn a simple MACD trading strategy that extracts up to 50% annual profits and can create a windfall profit spike during the next market crash. Here's Andrew Faldy with Former Financial.
All right, welcome everyone. Let's go ahead and get started here. All right, today we're going to talk about how to use the MACD, the MACD, to extract up to 50% per year from the options market, ready for this, without trading options, using an ETF that represents one of the most popular edges in the markets, the edge that comes from options specifically, and that edge is called theta, or it's also known as time decay. And I'm going to show you how to use these signals to hedge a portfolio, so you can be profitable in the next market crash, and more importantly, without predicting or having to predict or guess when it will happen. And how to do all of this completely on autopilot with $0 commissions. And very important at the end, I'm going to show you how to get $25,000 in buying power to trade this strategy starting as early as next month, and how we're giving away 80% of profits and sharing 0%, you share in 0% of the losses. All right, so first, before we get into the meat of this, don't miss future videos where we talk about strategies, indicators, automation, options, etc., and give you step-by-step strategies on how to gain edge in the markets. All right, so go ahead and subscribe and set your alerts. So, my name is Andrew Faldy. I'm a former commercial investment real estate broker. I did $300 million in deals, doing apartment buildings, shopping centers, industrial distribution facilities, developments, things like that. So I didn't like that business, and I switched over and decided that I want to get into trading. And so I did that in 2010, and I've been a pro trader ever since. Wrote a book that kind of outlines my perception on the markets and my experience trading professionally. It's called Skip the Dip, How True Diversification Can Profit During a Market Crash Without Predicting When It Will Happen. And in this video, I'm going to tell you how you can get your own copy of the book for free. All right, so first I want to tell you about the indicator. Then I'm going to tell you about the ETF, the instrument that we use the indicator on, that allows you to extract up to 50% annual profits from the options market without even trading options. All right, so the indicator is the MACD, or as I usually abbreviate and say it shorter, MACD. It measures the difference between a short-term and long-term moving averages. That is the foundation of how it works. But it dives a lot deeper into that, and it actually goes like this. Then it takes the difference between the two averages, and that's averaged, and another measurement is taken of the difference between the difference and the average of the difference. Okay, so if you felt like you just walked into a hall of mirrors and you don't know which way is up or which way is out or what just happened, then you are not alone. This is an indicator that gets very complicated very quick. So I'm going to break it down visually for you. All indicators, not all, most, 90%, 99% probably of indicators begin with price. That's what is the foundation of what we're looking at. So we start with price. And something we're very used to, and you're probably used to, is the average price, or what we call moving averages. Okay, so two moving averages are taken of the price, and then it measures the difference between those two moving averages. Got it so far? Not too complicated there. So we have this right here. The orange line is simply the difference between these two moving averages. Okay, so then after that, we average the orange line. So we add a moving average to the difference of the moving averages, okay? And then we have a histogram that shows us the difference between the average and the actual difference, okay? So I said to myself, is all this complication necessary? And I'm just here to tell you that we don't have to ponder if it's necessary. We don't even have to guess if it's necessary. We don't even have to debate if it's necessary. We can test it. And here's test number one. And the instrument we're going to use is the SVXY, or as it's referred to, the SVXY. And the SVXY is an ETF that tracks short VIX futures. If you don't know what that means, don't worry. You don't need to know what that means. I'm going to explain it real quick. If you are familiar with that, then you'll know exactly what we're dealing with. And it represents the implied volatility decay of options on the S&P 500. Some will just say it represents implied volatility, but it really represents implied volatility decay of options on the S&P 500. Okay? Simple version, when implied volatility of the market of the S&P 500 stays the same, options lose value over time. And that's why it's called time decay. All right? And here's exactly what I mean. This is the chart of the VIX. This is a volatility index. This tells you the implied volatility of the S&P 500 options, but it's always a snapshot, and you see what I have underlined up here. It's 30 days, constant 30-day snapshot. Well, you can't actually buy this. It's just a indicator. It's just a math calculation of what people are willing to buy options for on the S&P 500. And you can see that over time, the VIX stays generally sideways. It goes up a lot. It comes back down most of the time rapidly after it goes up. And generally, over long periods of time, it stays in the same range. Okay? And there is a futures market on the VIX, and it's called the VIX futures. And this is a continuous look at the S&P 500 options implied volatility. And what you can see from this is that it's constantly going down. And that's because this is something you can actually buy. This is the futures on the VIX calculation, and it represents what actually happens. That value decays over time. All right? That's what happens if you continuously expose yourself to implied volatility. And the bottom line, all you need to take away from this before we get into the strategy of how to extract profits from this, is that when VIX futures decay, when the VIX goes sideways and VIX futures decay, the SVXY goes up. Got it? That's all you need to know, except for one very important thing, and that's a big warning. Volatility ETFs are not guaranteed to perform as planned or as predicted or as even calculated. They can be derailed. A market crash can derail volatility instruments known as ETFs and ETNs. Okay? And this isn't always bad news, especially for active traders. It actually creates incredible opportunity for active traders. Okay? Because when the stock market crashes, and here's an example of the market going down 35%, SVXY lost 65%. And another ETF called the UVXY, which is the Ultra Volatility Futures Index, which is a leveraged approach to trading volatility, it, during that same event, spiked 1,200%. So the question I had, and I want to answer for you, is can we use the MACD to navigate volatility ETFs to earn income from options decay during quiet markets and then windfall profits during market crashes? If you'd like the answer to that, that's what we're going to talk about. And so the strategy we're going to use is very basic. I love basic, simple things. If we can make it work when it's simple and basic, then we can dig in, put the screws to it, and make it even better. But let's make sure it works really simple. We're going to buy the SVXY to earn income from options implied volatility decay. Remember, that's the short VIX. We're going to buy that ETF to earn income, and we're going to buy the UVXY to capture options implied volatility spikes. Okay, so we'll use them both long only. Very important, a lot of accounts, you can't short things. A lot of brokers, it's hard to borrow these instruments. So we're going to go long only. So if you're in retirement accounts or it's not available to short, this is long only, but we're using an inverse ETF that gives you the ability to short the VIX, and a leveraged ETF which really allows you to capture volatility spikes. All right, and we're not going to just buy these two and hold them. We're going to use the indicator. So we're going to use the MACD to signal when to buy and sell each of these. So volatility moves very fast. Things can change quickly and volatility can spike and then collapse very quickly. So we're going to use a 30-minute chart that will allow us to quickly adapt to changing market conditions. All right? And as I like to do, we're going to use the default settings on the MACD indicator. You can get in there and change the settings. You can change the inputs. You can change the time frame. You can change the average of the difference of the averages. You can change the averages that it's looking at. But what that lends itself to is what we call curve fitting or overfitting. And yeah, you can change settings and always find something attractive in hindsight. But what I like to do is just take the default settings, the default indicator, and if that works, then maybe we'll dig into something better. All right, so very simple. What we're going to do is we're going to buy when the indicator crosses over the histogram. When the histogram turns green, we're going to sell when the histogram turns red. Basic enough. Standard settings on a 30-minute chart of the SVIXY. Now, this signal has occurred over 1,000 times in 9 years. Now, it may sound like a lot, but spread out over 9 years means it's not actually hyperactive in its trading, but it is fairly active. All right. So what I did is I broke out my abacus, got some pen and paper, and I dug through the charts and I wrote down every single time that the histogram turned green and the histogram turned red, and I did the math to figure out how much you'd make or lose. Just kidding. I wrote a few lines of code and got all of that information automatically. Isn't that nice? It is very nice. So here are the results of using a long SVIXY on the histogram crossing zero. That's when the green bars show up, and when the red bars show up, we sell. So when the histogram is above zero, we buy, and we sell when the histogram is less than zero. The market we're using, SVIXY, 30-minute chart. We added penny slippage. That's a very important thing. What that does, it gives you a conservative assumption about what your fill prices are. Very important to add. If you don't add that, then sometimes the results can be very, very overstated, especially on intraday charts where we're using minutes, not days. And the end result of this over about 9 years, just under 9 years, was a 52.5% average annual return. Very solid return. Now, the downside of this is it did have a significant drawdown of 50%. Too high for my blood. I would not want a 50% max drawdown and then put my whole account into that strategy. But for context about that kind of return versus that kind of drawdown, the S&P 500 averages about 8% a year. And it has over 55% max drawdown. So this strategy, trading volatility, long only, volatility with signals, so being in only when it's rising and getting out when it's falling, gave you over 6 times the profit with less drawdown. That's a significant improvement. Now, it's not high performance. It's not quite good enough for what I'd want to put into it, but we'll see if we can dig in a little deeper. So next, what we'll do is a very simple thing. We'll add the trend. So we'll try to take signals only when it's already rising. And to do that is actually very simple. And what we're going to do is we're going to take these buy signals, but only when the orange line, the difference of the moving averages, is above zero. And we're not going to take these signals here when the orange line is below. Okay? So here we can go long, and that would be our buy signal, and then we would sell right here. And you can see that this would be a trend that we can follow in, and this would be the first time we can take those signals and not be in the signals going the other direction. So here are the results if we add the trend to the trades. We buy when the histogram and the MACD are above zero. That's the orange line and the green histogram. And we're going to sell when the histogram crosses back below zero. So we're adding the trend to buy, and we're taking all the exits. And the market is SVIXY, 30 minutes, standard settings, penny slippage. And what we get is a 34% average annual return. So a little less return, and then half the drawdown. So 15% less return and 25% less drawdown. So that is, although it's lower return, it's still greater than buy and hold the market with half the drawdown. And it's a better, what we call risk-adjusted return. We reduce the returns, but we reduce the risk even more. So that's a better improvement to this result. Now, we're going to get into what a lot of you are going to be far more interested in as far as what you can apply. So we've tested the indicator. Now what we're going to talk about is hedging. So are you more interested in hedging a market crash? I just showed you how to make money when things are kind of calm, how to beat the market even, how to get higher returns with less risk. But what about those windfall profits when things get derailed? All right. So let's add those same signals that we're using for SVXY. We're going to add it to UVXY. And that's the leveraged VIX futures ETF. And here's what happened. This is a portfolio study that takes both of the signals and puts them together and gives you the returns. You can definitely see it's a little more volatile, but let me point out two very important parts. Right here, this spike in profits is when the market actually dropped 20%. And this spike, which happened even faster and even steeper, happened when the market was down 35%. So here's a question for you. What would it mean for you to have a profit spike during a market crash? Very important. Would that be very valuable for you? I'm guessing it would be. But let's really specifically look at the math and what that means when you can add profit spikes during market crashes. So we're going to break this down into three parts. We're going to look at buy and hold, what would happen, and then what happens if you add just 10% to a hedging system, and then what happens if you add a 20% hedge to your system, okay? If you buy and hold and the market drops 30%, you're going to lose $30,000. And that means you're going to end up with a $70,000 account. That's a lot. That's a lot smaller. That's very painful. People don't usually like seeing a $100,000 account turn into a $70,000 account. All right? So what happens if we can just take a 10% hedge only? Well, two things happen. Sometimes we only think about the profit that comes from the hedge. But another very important thing that happens is we are allocating away from what lost money. So let's break that down. If we start with a $100,000 account and we have the drawdown, the market goes down, but the drawdown is less. All right, what's 10% of 30? It's 3. So we'll have $3,000 less drawdown because we had to take that money and move it into the hedge. So we lost less, plus we have the profit from the hedges. Now what I've done here is I've taken examples from many, many signals and gave a conservative kind of what can happen during a market sell-off. And what you've seen, I showed you, UVXY went up 1,200%, 1,200% during a 35% market correction. Okay, what some would call a crash, a very rapid 35% sell-off. Well, in that case, if you put 10% in and you made 1,200%, that would actually be a 100% return on your account. But all I'm going to do, I'm going to take a very conservative estimate that two things happen. Your signals aren't quite perfect. You never get at the very bottom of volatility, and you're not going to sell the top. You're going to capture some of the middle when you take these signals, not capture all of it. And I'm just going to assume that volatility doesn't spike as much. Maybe the sell-off is a little slower. So I'm not going to say you made 50 or 60,000. We're going to use a very conservative 1 times the hedge. That the hedge doubled, so that'd be like capturing a doubling of the VIX. Like if VIX went from 15 to 30, or maybe went from 12 to 50, but you captured a move from 15 to 30. That was your net capture. That's a conservative estimate, and it is exactly that. It's just an estimate. Well, if you have less drawdown plus a profit from a hedge, instead of being down to 70,000, you're only down to 87,000. Instead of losing 30%, you only lose 13% on just a 10% hedge. Very, very powerful. Now, what happens if you double your hedge? Well, it gets even better because you lose less because you allocated away from the core position and the core risk even more. So instead of 30 or 27, you lose less, plus you double your hedge profit. And in that scenario, just having 20% into hedging, reducing your drawdown, adding gains from the profit spike of volatility, you end up being down only 6%. That's really Good. So here's something even better. If you use signals to close or reduce size in the stocks during the market sell-offs, you could actually end up net profitable during a market crash. And the following equity curve, what I'm going to show you are the actual signals. This is not just you predicting that you think the market is going to crash so you close your positions. We're going to be objective and scientific about this and use valid signals that tell you when to buy and sell. And so the following equity curve represents a real-world scenario trading signals on the S&P 500 ETF, the SPY, during the COVID-19 recession. And this period right here is where the signal said to go flat. And this is a date timeline, okay? So whenever it is flat, the line is flat, it means you're flat the market. You sold and you stayed flat. So the signal to sell and stay flat happened right around the end of February, but right at the beginning of March of 2020, and you stayed flat during a 35% market correction. So what does that mean? I'm going to run through these quick. If all you did was reduce the size of your drawdown, and look how conservative I'm being for you. What actually happened there is it sold right near the top and was out during most of it. But I'm just going to say instead of losing 35%, you only lost 10%. Isn't that conservative? The reality is you should be able to keep that down 3 or 5% in that scenario. But I'm going to go ahead and use a conservative estimate that you did lose 10% instead of 35. Well, then you'd be at 90,000. And that's with no hedging. That's no hedging. That's no SVIXY trade, no UVIXY trade, no allocation away from the losses into hedging. That's just because you stayed out of the market when it was dropping. That alone could be powerful enough if you never add a hedge. But what happens if you add that 10% hedge on top of getting out of the market when it's declining? Well, you have your 100,000 starting point. You reduce your drawdown because you reallocated. You add your hedge, and here's the magic. With just a 10% hedge, in long volatility on signals, plus using signals to reduce your size or get out of the market during a 35% correction, you can actually, while the market's down 35%, be up with just a 10% hedge. Now what happens when you go to 20%? It's even better. You lose less, you double your hedge profits, and you're actually up 12%. In that scenario. And it still gets even better. When the market's down 30%, 35, 40, 60, whatever it goes down in the future, you can close your hedge and ride the market back up. Now, does that mean you have to know when to close your hedge? Do you need to know when the bottom is in? Absolutely not. People who talk about that in hindsight or try to tell you how to guess when the market's bottomed out, they're just blowing smoke. All right, so here's our objective way to do it. What we do is we use the signals. So right here, when the MACD crosses back below, we sell the market. And this is our UVIXY hedge. So we wrote it, we bought it here, we got out here, we got back in here, we wrote it to here, we bought it here, wrote it to here and got out, and we stayed out. We're out when the volatility comes back down. We're out of the hedge. In this hedge here, you can see, wrote it from about 30 all the way up to 130, and then you capture that net movement plus a little missing out. You can see why I didn't give you a 1,200% gain. I just assumed maybe a 100% gain, trying to be very conservative for you. All right, so you capture those profits, you put them aside, and then what? Now you're all in cash. But eventually the market's going to return. And so right here, after you see that this is the SPY, MACD signals, right after the correction was done, we started buying again, we have a flat signal, we buy again, we have a flat signal. So we start trading multiple signals all the way through the recovery. So we're flat when the market drops, and then we ride the recovery on signals. Well, the math, as you can imagine, gets even better. If all you did was use signals to navigate a market correction, so you got out as it's going down, and then you capture not all of it. Market's down 30. I didn't say you make all 30. Yeah, you're probably not going to capture quite the bottom. Okay, so you get 20,000 on the way back, 20%. You're profitable. Reduce how much you lose on the way down. Make more as it recovers back up. You can be profitable during a market crash on the recovery without hedging. What happens when you add hedging to it? Well, first, because you had to reallocate the hedging, you lose less. You make the hedge profits plus the recovery profits. Now, we also reduce our size because we have money allocated to hedging. But all in, up even more. And then on a 20% hedge, you lose even less, you make more on the hedge, you get the recovery also, and end up even farther ahead. All looks good, right? Well, if it's that easy, why doesn't everyone do it? Maybe that's where you're at right now. You love it, it sounds good, you like it, but if it's that basic, you can use one of the most popular, one of those well-known indicators in the world on basic ETFs, and you can make 30% when the market goes down, you can make money when the market goes up. If it's that easy, why isn't everyone doing it? Well, in my experience, 10 years plus being in this industry, trading professionally, funded accounts, teaching others, developing systems, I've kind of boiled it down to this. 10% is knowing how to do it. 10% of your result is knowing how to do it. 90% is the discipline of actually doing it. And I don't mean just trying it a couple times. I mean doing it every single day for the next number of years that you're going to be doing it without deviation, without second guessing, without closing things early or hanging on to things too long. 90% of it is just doing what you already know. And in my experience, the absolute best way to follow through on what you know and to avoid the emotion-driven decisions to break your rules is simply to automate. And that's what I've done, and that's what I'm helping other traders to do. This is my trading office. This is where I'm sitting right now. You can kind of see over my shoulder. It's exactly where I am. I'm sitting at this desk that's kind of in the foreground of the picture, and I have the computer behind me. And so what I have is I used to sit at the computer that has all the monitors. And I had all those monitors just shining in my face all the time, and I was looking back and forth and up and down and all over the place, and it got a little old. And I actually kind of decided that it was not a healthy thing for me to be doing. So I actually turned them around, put them on the back wall, set them up where if I'm going to go look at it at all, I have to stand up and do it. And I turned around, and this is where I actually spend most of my time, where I'm kind of looking at you sitting at this desk when I'm working. And I build things here. And the things that I build here, I automate back here. I build it on one machine, a simple laptop with a monitor attached, looking out a window in a much more peaceful way. And I then take what I build and I automate it on a machine that runs everything for me. And more importantly for you, I take what I work on and what I build and I share it. And I record things and I share them in the community and I give them away to traders because we love to collaborate and we love to build things together. So if you want to learn how to capture unique profits from the options market using ETFs and reduce losses or even grow your account during a market crash, and become the most consistent trader you can possibly be. And you would like to learn how I explained earlier, you could get $25,000 in buying power to start trading these strategies as soon as next month. And what we're doing is giving away 80% of the profits, and we are taking the risk you share in 0% of the downside losses. I invite you right now, go to learnautomatedtrading.com. And when you get there, I'm going to show you what you're going to see. On that page, there's going to be a lot of information about what we do. It's going to talk about automation and the program and how you learn things like that. But what you can do is scroll down and you'll find a video that looks just like this, and you can watch that presentation. And that presentation will show you how to have a fully automated trading system, actually multiple trading systems, in about 28 days, even if you've never written a line of code in your life. All right. And as I promised earlier, I want to show you how to get your free copy of Skip the Dip. So what you do is you can go to this web address too. So you have two assignments. One is to go check out automated trading. The second is go get your free copy of Skip the Dip. And what you do is you type into your browser skipthedipbook.com. skipthedipbook.com, and you'll be given a special offer where you can get your copy, a physical paperback copy, mailed to you for free. And so what I want to invite you right now is to prepare now to profit in the next crash. That is what I want for you. That's what I have done for myself, and I'm helping other traders to do, is to have the confidence that they can objectively and consistently navigate the markets to reduce their losses, maximize gains, hedge, and create outsized profits even when the market goes down, and especially when it's going up. So if you want to learn how to do that, go to learnautomatedtrading.com and you can learn more about that. All right, so head on over there and I'll see you in that video. In the meantime, make sure before you head over there, subscribe and set your alerts for this channel. All right, thanks for watching and I'll see you later.